Wall Street extending its gains Wednesday afternoon following the release of the minutes of the last Federal Reserve policymakers meeting. Right now, the S&P 500 up about 1%. For more on the minutes and the markets, let's go to Santa Monica, California, where we're joined by Ben Dunbar. He's a financial advisor at Gerber, Kawasaki. Welcome, Ben. So what was it about the Fed minutes that the markets liked?
Well, look, there's no surprises, right? They're still planning to continue cuts, and they're basically concerned about all the tariff stuff going on, and they're not going to raise rates, nothing like that. And so the market's just happy there's no surprises in the minutes. That's what they were worried about.
And the minutes, some policymakers argued for the need for an insurance rate cut. Others said, hey, the economy doesn't need it. The minutes, as it read, does it change your view in terms of the likelihood of a rate cut later this month or the number of cuts that we'll get this year?
It's pretty challenging to say because ultimately the Fed already has interest rates so low. And yes, an insurance cut sounds great, but what bullets in the chamber are they going to have if the market, if we hit a recession, if things get substantially worse? So I think there's a decent chance that we'll still get another rate cut, but it's going to be hard to tell here moving forward.
All right. Now, investor sentiment today seems to be buoyed by encouraging news on the U.S.-China trade front. Some media reports saying that China is still open to a partial deal and that they're willing to buy more U.S. farm goods. But would a partial deal be enough to satisfy Wall Street?
It's just going to be how Trump talks about it. I mean, look, it's hilarious. We've been talking about the same things for over a year with all this trade stuff. And before we know, we're going to be coming into an election. And so I wouldn't read too much into the headlines. You talk to a lot of people who are not really progressing too much on the trade deals. We got a lot of issues. I mean, it's how it's marketed to the public and how people react. But I wouldn't read too much into it. There's obviously a lot of issues still going on.
Ben, are we even getting close to a partial deal, given all the noise that we've heard this week? The U.S. ratcheting it up by widening the blacklist of Chinese firms and also considering the visa restrictions that Washington will slap on some Chinese officials over the minority Muslim Uyghur issue. Are we even getting closer to a partial deal?
Look, I think we do have some form of a partial deal because at the end of the day, we are two major global economies and we both need each other. So these conversations need to be had. But if we can't make some form of a deal, it's going to hurt the U.S. and it's going to hurt China. We think it's going to hurt China substantially more. But ultimately, we're starting to see manufacturing numbers in the U.S. You talk to people around, people are starting to get affected by tariffs. So it's a real issue. And so having some form of a deal, we are hopeful to have it, but it's not going to be any sort of major deal.
Well, given all the noise that we heard on U.S.-China trade, it seems to lift the markets one day, take it down the next, now up again today. What's an investor do with all this noise? What are you telling your clients?
So now is not the time to be really aggressive. There are a lot of issues going on globally and in the U.S. The U.S. consumer has been saving the market so far. We see low unemployment, so there's a lot of good reasons to still be invested, but this is not the time to be aggressive, and then this is not the time to be trading on these headlines. Ultimately, remember the companies that you own and why you own them. Focus on that rather than if a deal is done today when tomorrow it's not done and then the next day it's done again.
And for your thoughts and ideas.
Thanks, Fred.
Our thanks to Benjamin Dunbar of Gerber Kawasaki joining us today via Skype from Santa Monica, California. I'm Fred Katayama, and this is Reuters.